panic in the markets early in the week as the Bank of Japan decided to increase interest rates, thus impacting the carry trade and forcing investors to liquidate positions in stock, commodities, and cryptocurrencies to cover. In the next few minutes, I'll explain to you what went down, and I'll address an even more important question. Are we out of the woods yet? A little something you should know about Japan's central bank. In 1999, they introduced zero interest rate policy. They also implemented quantitative easing back in 2001. In addition, the Bank of Japan had refused to raise interest rates, even when it was clear inflation was spiking. This sent their currency, the Japanese yen, into a freefall in the last 4 years. So, as soon as the Bank of Japan started mentioning a possible hike up in the official interest rate, the yen began moving higher. Why? Because this meant borrowing Japanese yen would become more expensive. And when the Bank of Japan actually decided last week to raise the interest rate from 0.1% to 2.5%, the yen exploded higher, sending carry traders into panic. So, what is carry trade? A carry trade relates to currency arbitrage, meaning borrowing money at low interest rates to deploy it in assets that yield a higher interest. Many investors borrowed Japanese yen that had a near zero interest and used that money to purchase assets like stocks, commodities, and cryptocurrencies. Imagine having 1 million yen in your bank account, which allows you to borrow 10 million at 0.1% interest, meaning you only have to pay 10,000 in interest. You could deploy that money into the S&P 500 that on average yields 8% a year. After 1 year, you'd have 790,000 in profit. Not bad, huh? But what happens when interest rates go higher? Well, now you are in trouble, because now you need to have a lot more funds in your bank account. And you need to pay 250,000 back in interest on a 10 million loan. So what do? You sell whatever assets you can to cover. However, that is not as easy as it sounds because of the rules of supply and demand. Remember those? As more people try to exit their positions, prices go down, and as more people chase after the Japanese yen, the price goes up. Therefore, moving fast is of the essence, because things can get ugly quite fast, which is exactly what we saw at the beginning of the week. So, are we out of the woods now? After the Monday scare, things seem to have calmed down a bit, but there are still many signs that point to a degrading economy in the US as well as other places. Besides that, selling begets selling. So, for the time being, I would argue that an ounce of prevention is worth a pound of cure. If you have found this video useful, don't forget to like it, share it, and subscribe to the channel. Disclaimer. The content provided on this channel is intended for informational purposes only and should not be construed as financial advice, investment advice, or a recommendation to buy or sell any security or digital asset. The information presented is based on publicly available data and is subject to change without notice. Viewers should conduct their own research and due diligence before making any investment decisions. The channel owner is not responsible for any losses incurred as a result of decisions made based on the information presented.